major changes are coming for real estate investors in Canada specifically, and almost nobody's talking about them. OSFI, which is the federal banking regulator, is rolling out a new 2026 rule that will change how banks calculate income, how rental mortgages qualify, and how fast investors can scale a portfolio. If you even own one rental property, this affects you. So today, I'm actually going to break down what's changing, why it matters, how this could impact your ability to buy, refinance, or renew an investment in Canada, or even specifically here in Ontario. So I want to get into this. Let's go. Let's start at the top. There's a lot of noise about what's out there with the OSFI income changes, or you'll hear new rental mortgage rules. But here's the clean version. And this is what I understand. And if it's incorrect, please comment below or call me because I really need to know. But this is how I'm interpreting it. This will all happen in the first quarter of 2026. OSFI is introducing a new clarification, which is income producing residential real estate. So let's call it IPRE. This category affects how much capital banks must hold against certain mortgages. When does a mortgage fall into this IPRE category? A mortgage becomes IPRE when more than 50% of the income used to qualify for that loan comes from rental income of the same property. And lenders are not allowed to double count income that's already being used to qualify for other properties in a borrower's portfolio. So this is going to be a crown jeweling change of 2026. So let's translate this for you. If your rental income is being used to carry mortgage A, you can't use that same rental dollar again to qualify for a mortgage on, let's say, mortgage B or C. This is what the industry is calling one income, one loan, and it's a new rule. So what's important is that these are capital rules, not borrower stress tests. OSFI isn't rewriting TDS or GDS rules, but because capital requirements affect lenders' risk, they end up shaping what banks are willing to lend and at what rates. So I hope you're following along here. So why this matters for rental investors. Let's break down how this impacts an everyday investor. So whether you have one condo or 10 units in Hamilton and Oshawa and Mississauga, this is how it's going to affect you. It's going to be harder to scale your portfolio's income. In the past, many lenders would do this. They would add up all the rents from your properties. They would subtract all your expenses. They would add your employment income from your regular job and approve the next property based on the global income picture. So going forward, each property must stand on its own. If property A's income is being used to cover property A's mortgage, that income cannot help qualify for property B or property C. More rental mortgages will be branded as higher risk. And if the bank needs to rely heavily on the rent to qualify the borrower for the property that they're about to buy, the IPRE loan requires the banks to hold more capital, which usually leads to a slightly higher interest rate for you, the investor, on the mortgage, more conservative loan-to-value limits, so you'll probably see 70% loan-to-value, stricter rental offsets or add-back calculations, and a greater focus on true net cash flow or DCR. Also, a less appetite for aggressively leveraged portfolios. So lenders can go even stricter. OSFI gives banks the option to classify rental mortgages as IPRE if the internal policies rely on 50% of the gross rental income for the calculations. Some big banks may choose to simplify everything in a different route. Now, renewals may be priced differently here. Existing mortgages won't be forcibly qualified by OSFI, but lenders may do the following for this if you are renewing a rental property. They may price rental rates differently for your new renewal. They might be pickier if you're going to refinance. They might reduce the maximum equity takeouts. And that could really affect you if you're wanting to buy another property. Now, there's another piece that gets mixed into this conversation, and the loan-to-income ratio framework. OSFI is studying borrower levels capacity at 4.5 or 5 times their income. They'll evaluate until at least the end of January 2026 before deciding how to use it. This is separate from the IPRE, but the two combine a lot of pressure. There'll be highly leveraged investors, multi-property borrowers, and people who rely on portfolio income to expand. And if caps come into effect, it's another break on aggressively scaling. So now let's dive into a real-world example. Let's break down a relatable investor scenario. Example number 1. A borrower earns $120,000 and they want to qualify for a condo. If more than 50% of the income used to qualify for that mortgage comes from the condo rent, it's an IPRE. So the effect is a small rate premium, a slightly higher LTV, and obviously more documentation on rental income and expenses. Example 2, investor with 3 rentals and they want to buy their 4th. This is where it's really going to affect all of you out there. Currently, many lenders are using combined rents from all the properties to qualify for the 4th mortgage. In 2026 and onwards, lenders must allocate property A rent to property A, property B rent to property B, and property C rent to property C. Only leftover income can support the purchase of property D or mortgage D. This significantly slows down portfolio growth. Example 3 here is a refinance to take out equity. If a mortgage relies heavily on rent, which means more capital required, which means lenders might reduce your maximum refinance loan to value, your maximum allowable equity takeout, and any interest rate discounts. I hope that all made sense. What stays the same? Not everything is changing. The stress test still exists. Existing mortgages won't be reclassified midterm. Not all lenders are OSFI regulated. Credit unions, some mix, some private lenders may behave differently. Banks build their own credit policy responses. Some will be stricter, some might be more flexible. What you should do as an investor next? Here's a few takeaways. 1, clean up your rental financials. Update your leases, track your expenses properly, and maintain vacancy and repair buffers. Also have an accurate net cash flow number. 2, strengthen your employment income. The higher personal income, the less your rental portfolio becomes over-relied on during qualification. 3, expect differences across lenders. Federally regulated lenders like the big banks will be the strictest. Credit unions and specialized lenders may become more competitive for investors. And plan purchases strategically if you want to buy another property. With the one loan, one income interpretation, investors will need to sequence their purchases more deliberately. OSFI isn't trying to ban investors, it's trying to stop lenders from stacking thinly and service rentals mortgages on top of each other. The practical outcome is the same. Scaling a real estate portfolio in Canada is about to get harder. If you're an investor in the GTA or anywhere in Ontario and you want help understanding how these rules might affect you, whether you are doing a purchase or you're refinancing, and you want to also talk about your long-term portfolio strategy, please reach out. Click the link in the description and book a call with me and let's go through this together. But make sure you like and subscribes and hit that little bell thing so you don't miss any updates, because I'll be breaking down every major housing and mortgage policy that's coming through 2026 and how it's going to affect investors and just regular people trying to buy a home.